You've just been named the trustee of a trust. Now what? Hi, my name is Michelle, and I'm a financial advisor here at Financial Design Studio, where we help business leaders transition into retirement. If you're starting to think about your own retirement planning, you can download our free guide below to read how we help clients with this. Now, today we're specifically talking about trusts. One of the financial responsibilities many people encounter in retirement is serving as a trustee for your parents' estate. It can feel like a huge responsibility to manage someone else's finances, to also honor their wishes, and to deal with family dynamics all at once. So, very simply, what is a trust? And a trust is a document that governs how assets should be managed. So, let me draw this out so it's easy to understand. So, very simply, you or someone that you love is the owner of something. And when you have a trust drafted, now what you are doing is you're basically saying, this asset that I own as the owner, I am going to put into the name of a trust so that it's protected and so that when something happens, that asset can then be distributed to who I want it to be distributed to. So all you're doing is changing the ownership from you personally to now a trust or kind of another entity. Now, after you have this trust created or in the process, you actually name a trustee. So you name someone who is actually going to manage this trust for you. Now, this could be, for example, a trust. We could be putting assets in there like a house. This could also be like financial assets. So think of stocks, bonds, anything like that. And so what we call those people who you're passing these on to is a beneficiary. So let's assume in this example, we have two people that you're going to pass this asset on to or these assets to, and you want them equally to inherit whatever that is. And so ultimately they're receiving the distribution of or the funds from whatever you're putting in the trust. Now, I do want to highlight something that is not your job. So, when this trust was created, the owner of this trust decided who these beneficiaries were going to be. The owner of that asset already decided and said, this is what I want to happen. So, you as the trustee just need to make that happen. It's not your job to decide if anything should be changed. All right, so let's talk a little bit about the inheritance process and some of the steps in being a trustee. So we'll put together this trustee checklist to kind of help you walk through and understand what needs to be done. In the beginning, the first thing is that you're really making sure that you have a death certificate. So one of the first things is when someone passes away, that usually the funeral home will order these for you. So it's making sure that you're getting the quantity you think you'll need, but getting those death certificates because that will be needed in any of these things you do to prove that someone has passed away. So typically it's that death certificate. And then also you need a copy of the trust. So this trust document that we just talked about that has been put together, drafted by the owner, that's what says this is what needs to happen. So you need a copy of that trust. And then thirdly, I would say is that you start to identify who the professionals are that are going to help you in this process. Now, this can be, for example, an accountant, this could be an attorney and a financial advisor, a team of those few people, or maybe the attorney that you're working with already handles estate tax, or the financial advisor can help with the tax implications as well. But I would say a combination of 2 to 3 of those specific professionals are going to be who you're going to need to help work through the issues and the questions that come up. Now, one of the big tasks, honestly, that happens or that trustees need to be able to do is paperwork. And that will not sound like a very fun thing, but honestly, there is a lot of paperwork. And depending on the complexity of someone's estate, their trust, all of the accounts that they have, the assets that they have, there could be a lot of paperwork. So let's just kind of talk about some of those specifics that you'll need to be able to handle. So first, some of these little ones are things like just paying bills. So being able to pay bills, whether that was final bills, whether someone lived in a living community or whether they still lived in their home and maybe there's medical bills from the hospital, things like that that need to be paid. Next, it could be paperwork to consolidate and maybe even distribute some of these financial accounts. So, for example, a trust can actually last many years, or it could just very simply say, once I pass away, these assets need to be distributed right away to these beneficiaries. Another thing that you might need to do is to sell assets. So, again, in selling assets, there's going to be paperwork that needs to be handled. Another thing is talking with beneficiaries. So, this isn't necessarily paperwork, but this is actually something that I think is really important. So, like we mentioned, every owner of the trust can decide who the beneficiaries are. If you can talk with the different beneficiaries, sometimes you might be surprised that they actually have some expectations of how they're going to receive their funds, when they're going to receive their funds, or how they don't want to receive them. One of the biggest goals as a trustee is that you want this process to go well. You're trying to do a great job of managing and distributing assets to the beneficiaries in the best way, the most tax efficient way that you can. So it is really important to have a good relationship with them. And as much as you can, if you can distribute things the way they want to, that's really great because then you're helping them accomplish what they need to as well. One of the other things that you'll need to be able to gather or find are things like statements for accounts, or even maybe a deed of property or titles for a car, things like this. Because again, if you're needing to sell these assets, you're going to need to know where these documents are. And then finally, the paperwork to actually do the management of the trust account and the distribution. So, for example, if you're going to have checks distributed to beneficiaries, if you're going to have actual stocks just transferred to beneficiaries, there's going to be paperwork to actually make those pieces happen. So let me show you two different scenarios to explain and help you see the tax implications of how you distribute these assets. So in this first scenario, for example, we're going to assume that someone has assets of $1 million, and these assets are financial assets. So think of stocks, bonds, cash. It's a combination of those in accounts that this individual has in their trust. And in this first scenario we're going to do is we're going to assume that we sell everything that this person owns. We're going to sell everything in the trust and we're going to distribute that to the beneficiaries, 50% each. So they're each going to get $500,000. Now, one of the things now that you have to consider is that because you sold everything here, whenever you sell financial assets, you have to consider, was there a gain on those assets that I sold? So, for example, from the time that someone passed away, so the old owner, from the time that they passed away until now, when we're selling these assets, has there been a gain? And so, if there was a gain from this, now in the trust, what can happen is that very quickly with a trust that you can very easily get to a 40% tax rate on the gains that you're paying from that sale in the trust. Now, let me show you a second scenario to give you an idea of something else you can do to limit or maybe avoid paying taxes at all. So, for example, we're going to say the same size account, we've got $1 million. Similarly, it's still in stocks, bonds, and cash. And instead of selling everything, in this scenario, we are not going to sell everything. Instead, what we're going to do is we're actually just going to distribute, again, the $500,000 to each of the beneficiaries. But in this scenario over here, we were giving them cash. We were selling everything and we were just giving them a check for cash. In this one, we're actually going to give them those same things. So we're just going to transfer half of the stocks, the bonds, and the cash into these beneficiaries' accounts that they want them transferred into. So we're just very simply moving them from the trust account to the beneficiaries. So what you notice is that we didn't sell anything. So if there were gains, for example, in this account, those are now just going to carry on to the beneficiaries. And now the percentage that it's going to be taxed at depends on the beneficiary's tax bracket that they are in. Now, one of the interesting things is that when you look at the income tax bracket for individuals, whether that's a single or married filing jointly, It takes a lot of income to get to a 40% tax rate or even close to it. So, this is why even someone who has good income, who has assets of their own, if you're now adding on the capital gains from any of the trust, you're choosing when you sell these things. You're choosing when you sell the stocks, you're choosing when you sell any bonds, so that you can now plan the taxes based on when you're able to pay them rather than being forced to pay them at this 40% high rate. So if you're starting to plan for your retirement, again, you can find our guide linked below. And this is what we do best. Our team specializes in comprehensive financial planning and investment management, so you stay on track all year, every year. Reach out to our team at financialdesignstudio.com to schedule a 30-minute consultation about your retirement plan. We'll see you there or in the next video. Thanks for watching.